The air was thick with economic anxiety this week after a stunningly weak jobs report revealed the pace of hiring in America had slowed to a crawl last month. As dismal employment numbers trickled out, speculation swirled that the Federal Reserve may have tragically misjudged the need for lower interest rates to rejuvenate the sputtering economy. On Wall Street and in ivory tower economics departments alike, a heated debate raged over how the Fed should calibrate its response at the next policy meeting in September. Some prominent voices, like those at J.P. Morgan Chase and Citigroup, loudly clamored for a hefty half-percentage point rate cut from the central bank to jolt the job market back to vitality. In the frenetic futures trading pits, investors feverishly priced in expectations of not just a 50 basis point cut next month, but at least that much again by year's end. Yet as the vociferous calls for aggressive stimulus intensified, other sage voices in the economic sphere sounded a more measured tone, cautioning the Fed against overreacting to 1 month's soft data. Among them was the level-headed Austin Goolsbee, president of the Federal Reserve Bank of Chicago, who in the wake of the jobs disappointment preached restraint. "We'd never want to overreact to any 1 month's numbers." Gregory Dacko at Ernst & Young concurred, predicting the September meeting would indeed produce a rate cut, but arguing there will be resistance to a 50 basis point cut, given the Fed's ingrained hawkish bias on inflation-fighting credibility. Joseph Lavorna at SMBC Nikko Securities was even more adamant that a half-point move would be excessive, warning bluntly, "If the Fed goes 50, it will look like panic." The debate highlights the devilishly difficult predicament Fed Chair Jerome Powell and his cohorts on the Federal Open Market Committee now confront. Move too timidly, and they risk failing to provide sufficient stimulus to recharge a job market that appears to have hit stall speed, jeopardizing the economic fortunes of millions of American workers and their families. But overcorrect with too much rate-cutting vigor, and the Fed could squander its hard-won inflation-fighting credibility while sending panicky signals about the true severity of the slowdown. Facing such a harsh landscape of difficult-to-parse economic crosscurrents, the Fed has historically favored a more cautious, incremental approach on rate moves absent crystal-clear signs of imminent crisis. As Richmond Fed President Thomas Barkin articulated, more significant reductions typically would be associated with an economy that feels like it's deteriorating rapidly. Even he regarded July's soggy 114,000 job gain as still a reasonable number. Indeed, since Powell assumed the chairmanship, the Fed has largely eschewed splashy, jumbo-sized cuts except in moments of acute emergency like the COVID-19 outbreak or last year's blistering inflation spike. Its usual modus operandi is to adjust rates gradually while monitoring a broader range of economic indicators beyond just the latest monthly payroll figures. Still, the jobs slowdown cannot be dismissed as an ill omen. Analysts at the forecasting firm Evercore ISI view a 50 basis point September cut as a realistic possibility if deterioration in the labor market becomes more pronounced. Echoing that, Diane Swank at KPMG warned, they will be forced to cut more aggressively before the window on a softish landing closes entirely. The clamor for accelerated easing even attracted the notice of Democratic political firebrand Elizabeth Warren, who issued a stinging broadside on social media demanding Powell cancel his summer vacation and cut rates now, not wait 6 weeks. For seasoned Fed watchers, however, such shrill partisan attacks from Warren are par for the course and unlikely to sway the apolitical institution's thinking. More impactful may be evolving views among policymakers themselves that downside risks to the expansion are mounting. At his press conference this week, Powell acknowledged an increasing prioritization of the employment side of the Fed's dual mandate now that inflation has receded. He may soon face pressure to walk the tightrope more deliberately by delivering enough of a rate cut jolt to recharge job growth without going so far as to risk market panic or a return of runaway price pressures. Striking that precise balance has always been the essence of skillful central banking in tricky economic seas. After this week's employment shocker, the coming months will put Powell's prodigious tightrope walking abilities to the test once again.